All right, good morning. It's 7 a.m. Eastern. Welcome to FX Street. Thank you very much, FX Street. My name is Adam Rosen. Welcome. Good morning. It is great to see everyone here. I love these open access days. CVJ, I know all my regulars are here as well. I love it. Boyke, I knew you'd be here. How's everybody today? It's great to be here. We have a ton of stuff to go over, so I'm going to jump right into it. Of course, if you have any questions, comments, concerns, please feel free to chat them in. If you cannot see the chart for any reason, please let us know. Can you folks see the chart okay right now? I assume that you can. Please tell me if you cannot, and I'll refresh it on my end. But you can see the chart. Excellent, excellent, excellent. Okay, let's get started. Excellent. Wow, wow, what a big room. Okay, let's get started. What we are going to discuss today is something that's very, very common, very, very important, but you know me, I like to go back to the basics. Why not? We are going to discuss how we classify the market, foreign exchange market, stock market, you name it, into two basic conditions. We have range-bound and trending markets. I know this might be a little bit basic for some of you, but I promise we'll try to make it entertaining and fun. Also, I have a very special free gift for you, but I can't tell you yet. Remind me before the end of the show, in about 40 minutes from now. It's a very, very, very free special gift. Okay, trending markets, what we're looking in front of us, daily chart, gold. Trending markets, quote, have the potential to make new highs or new lows over a given period of time. Range-bound markets do not make new highs or new lows. In a trending market, the easiest way to say this is 10 p.m. down under. The easiest way to trade a trending market is to remember the trend is your friend. How many of us have not heard this? I think we've all have heard this. The trend is your friend, and that simply means when there's a trend in the market, when the market is making new highs and new lows over a certain period of time, we should do our best to only trade in the same direction as that trend. In this case, to the upside. So in a gold chart, in the following gold chart, I only want to look for long opportunities, places to go long. And does that mean that if we sell short, we can't make money? Of course we can make money. There's a lot of ways to make money. But what I'm looking to do, my goal is to put my capital at risk only under the most optimum conditions. You know, when they test fly a new fighter jet or the space shuttle, whatever it may be, I'm sure they do about a gazillion tests to make sure that the wheels are attached and you know, there's enough fuel in the tank and that everything's been triple checked. Well, this is what we want to do. Our capital is just as precious. We do not want to risk capital unless every single check and safety precaution has been taken. This is one of the first precautions, is we want to make sure that if the market has a trend, we're only trading in the same direction as the trend. Okay, therefore I want to go long. Well, where do we go long? Near support. Well, you may ask, well, what's support? Support is the bottom lines. We have two support lines in this case that connect the most significant low prices. And this tells us that over a given period of time, the X and the Y axis, that over a certain period of time, the market has a tendency to move up by a certain degree. And that creates the angle of the support line. Now, oftentimes, a resistance line, which is our ceiling, will fall parallel to that support line above the market, connecting the significant high prices. If you can find, it's not always the case, but if you can find support and resistance lines that fall parallel to each other, it's an extra source of confirmation. If you can't, it's not the end of the world. But in this case, we want to go along the market the next time it tests and fails to break below support. In this case, we have two possible support levels. I'm going to zoom out on the chart and give you a little bit of a bigger idea, bigger picture of what we're looking at over here. And essentially, we have a long-term support line drawn connecting significant low prices. That currently lies, by the way, for your general reference, around $850 for an ounce of gold. The uptrending, more aggressive support line lies at $895. So if I were to trade gold on a long-term basis, and this can be applied to long or short-term basis, but a long-term basis, if I were to trade gold, I would want to go long the next time it tests and fails to break below support. It just did on yesterday's daily candle. I would want to place my protective stops below the support line, where the market has where the market does not have a good chance to trade to. Now, if our stop is touched, it means that either our analysis of the chart was wrong, meaning our support or resistance lines were a little off, or the market simply broke through. which is very, very possible. Then I would wait for the market to test and fail to break below our lower support line. But in this case, the market gives us two chances to go long gold. And if we're right, the beauty in trending markets is it provides a very much favorable risk-to-reward ratio. Risk-to-reward means we have the potential to make at least, for example, 3 times as much as we risk in any trade. We want to look for those trades where we can make 3 times as much as our risk. Therefore, if we're right only half the time, then, over a long period of time, our account equity will hopefully grow to the upside. Now, let me refresh the charts. All right, what we're looking at now is dollar-yen, and this is, I'm so glad the markets broke out in the past couple of days because it gives us a lot to talk about. The dollar-yen was in a range-bound market. This is a range-bound market. Now, I know there's a spike low at the bottom of this chart. We'll talk about that in a moment. However, notice how the market over this period of time, this range-bound little cluster here, failed to make new highs or new lows. In a range-bound market, the trend is your friend does not necessarily apply. In this case, we can simply use a very, simple buy low, sell high type of approach. Well, we're going long near support, again, connecting the significant lows, and selling short near resistance, the significant highs. In this case, we want to take profit, probably in my case, in my opinion, in the middle of the trend, or the middle of the range, I should say, because we don't know for a fact the market will cross from resistance all the way down to support. Sometimes it won't. So in this case, I'd like to take profits, close the position, at least part of it, in the middle, in the exact center of this trading range. Now, what about that spike low? Well, that spike low, in my book, would have been a breakdown. However, notice how we crossed back above what we thought was support, that we thought was broken, and then we established this range again. The range then resumed. What this tells us is that that little spike low was an anomaly. We also call this event an upside down head and shoulders. A head and shoulders is simply a triple top or a triple bottom, where the head, which is the center low in this case, falls lower than the first or third. Now, I know we have a number of bottoms, 1, 2, 3, 4, I'm counting 4 or 5 actually. But the essential pattern of a very, very extreme low surrounded by more moderate lows gives us an upside down head and shoulders. A general rule of thumb, head and shoulders tends to break in the opposite direction of the head. In this case, the head was at the bottom, and then we resumed back into the trading range above that bottom. Therefore, the market has a tendency to break to the upside. Now, what if we're trading the range, but you say long-term, I think the dollar-yen goes up? Beautiful. So it's a great opinion. I could think of a lot of reasons why that's the case. I could think of a lot of reasons why it's not the case. However, if we are of the opinion that the dollar-yen goes up long-term, well, we want to buy as low as possible. There's nothing wrong with going long again at this low support line of 105.75. That's the support line. The resistance, by the way, is right around 108. So a little bit below, 108, to round it off. If I were to go long a position at the 105.75 level, yeah, I'd like to take some profits if it moves up, sure. But there's nothing wrong with holding on to a very small piece of the trade for the eventual breakout if we are correct. Now, I like to take most of my profits in the center of this trading range because, like we say, we don't want to buy a breakout that has not occurred yet. We are not in the psychic business. So, as much as I'd like to think I am, I'm not. But the fact of the matter is, if you have a fundamental opinion that you think the dollar-yen long-term goes up, then going long as low as possible and holding on to a small piece of that trade, there's nothing wrong with that. Now, what if this recent breakout that we see over here is a possible head and shoulders again? Well, it is possible. But what we'd have to see for that to happen is the market to cross back below our resistance and then fail to break back above. And that would create the opposite scenario. Which brings me to my next point. It's a very, very important precedent. We talk about this all the time. The precedent is in technical analysis. It appears we've broken above resistance, right, near the 108 level. If we have, in fact, really broken above this resistance, in my book, resistance broken should become new supports. I like to, for those of you that have heard me speak before, I'm sure this is nothing new. that if we break above, if we are sitting in our apartment on the Lower East Side of New York City and we fall through our kitchen floor, our old kitchen floor, as we sit in our neighbor's kitchen floor below, becomes our new ceiling. If we fall through our floor, it should become our new ceiling. If we crash up through our ceiling, our former ceiling should become our new floor. Well, the same precedent holds true in fifth floor walk-ups, as well as with foreign exchange and other technical, other markets from the perspective of technical analysis. Essentially, if we have truly broken above 108, I don't want to see the market come back below 108. Now, it can drift a little bit below, but I don't want to see the market resume this range. So in my book, if this is a breakout, how do I know it's a breakout? It should not go back below our recent highs that were subsequently broken. That's staying around 107.90, 107.85, almost 108. Well, if you are a breakout trader, it's not really my cup of tea. But if you are a breakout trader, I would want to go long the dollar-yen here, right around above 108, with my protective stops placed below 108, again, at a point where we don't think the market's going to go to. When we place a trade, we're basically, it's an hypothesis, it's a theory. Our theory is that the dollar-yen broke above this 108 level, and it's going to go higher. Well, terrific. Where should it not go? Back below 107.90, 107.85. Now, where could we go? A target? Notice a downtrending resistance. I'm going to zoom out and give you a bigger picture of what we're looking at here. Let's go to a daily chart for a moment, actually. This is beautiful. Let me refresh my charts for you folks. Okay. So what we're looking at over here is a dollar-yen in a long-term trend to the downside. Now, which is more important? The little range that we just broke above that could lead to a new trend to the upside on a short-term basis, or the long-term trend? Well, I always say the long-term trends, long-term support and resistance lines tend to carry a greater amount of weight. Therefore, would I want to go long here? Yeah, possibly, but it's not an ideal trade because I'm still trading against the overall direction of the currents or the tide or the market's momentum. Downtrending long-term resistance lines currently around 111, 111.40 roughly. So yeah, the dollar-yen could rally, but the dollar-yen could rally and then around 111, 111.40, I'm going to start to get very, very nervous about holding my long position. Now, if I don't want to take this trade because it's against the overall trend, I agree with you. You know, we just got done saying the trend is your friend, right? Well, this, for a long-term trader, would not be a trade. For a short-term trader, yes, it would. Short-term trader would say, hey, the trend is your friend. We just broke above this range-bound cluster over here, and now it appears the market's established a new trend to the upside. And a short, medium-term trader, this is a potential trade. But long-term trader, I'm trading only in the same direction of the trend, and that means I have to sit and wait patiently for the market to test and fail to break above our downtrending resistance and near 111, 111.40, and then take a trade. So much to talk about. Okay. The dollar Swissy daily chart, 110.46, another situation. Downtrending long-term trend. So long-term traders, I only want to sell shorts. Well, in this case, the dollar Swissy gave us two possible scenarios to sell shorts. We have our downtrending long-term resistance. That's currently all the way up at 113.70 roughly. Okay, wow, that's a long ways away. We also have a less significant downtrending medium-term resistance. We're currently above that right now. Okay? Now, if I want to sell short, and there's another way we can draw this resistance line, by the way, we can connect our significant high prices not in an angle, but on a horizontal level. And a very wise trader once showed me that, or really kind of taught me, that we should always try to note as well the horizontal price levels as well, especially in the foreign exchange market, as I struggle to get my line straight here. Because, that's close. Okay, because essentially what we're looking at over here is a market that affects everyone on a day-to-day basis. The difference between Google stock at $500 or $600 a share, it's a little bit difficult to quantify. But I can tell you, as long as the euro is near 140, I'm going to hold off on my European vacation plans. If the euro goes down to 115, I'll be the first one on a plane. So, and this affects not only tourism, just a silly example, but export, import business, trade, you name it. Every single person, whether we like it or not, is involved in a foreign exchange market on a micro or macro level, and therefore these price levels become that much more relevant. I'm going to try this line one more time, and we'll give you a horizontal line, okay? Now, it's a little bit of a science, a little bit of an art, trying to find these support and resistance levels. But we can see over here the big magic level in dollar Swissy currently lies right on 111. And you may ask, well, we did break above this downtrending resistance. We did. Could this be new support? Possibly. That's around 110, 110.15 roughly. But again, we want to look. I always like to pretend that I'm a detective looking for evidence to solve the case. The case is the dollar Swissy going to go up or down? Well, I'm looking for supporting evidence. Evidence to support my theory. That evidence is the market breaking or failing to break specific support and resistance levels. So, we did break above this downtrending resistance, this intermediate one, but we did not break above 111. Notice, 1, 2, 3, nearly a quadruple top, triple, quadruple top, right at 111. In addition, I love to see this. Notice a long candlestick wicks that tested and failed to break above 111. Yesterday's daily candle hit a high of 111.05, not enough. The high of February 7th, 111.04, not enough. The high the other day, that's January 22nd, 111.22. But you know where we closed? We closed down. So the fact of the matter is the market is able to test 111, but is not able to go above. Now, short-term trader, if we break above 111 and that shows us a new support level, then yeah, a short-term trade could bring us up to our 113 level. Please refresh the chart. Absolutely. Please let me know if the chart doesn't come through. Yeah, so a short-term trade above this triple top over here, yes, we could go to new highs. But a long-term trader, not in my book. And I like to err on the side of caution and only take the trade when it's going really in the same direction as a long and short-term trend. Some examples. I thought the best way to sort of paint the picture of this application of support, resistance, range-bound trending markets is to simply show you the current chart so we can give you accurate price levels as well. And show you a number of different variations, right? It's not the theory that's as important as, hey, where's the market right now, right? Dollar CAD, daily chart, long-term downtrending resistance. By the way, in downtrending charts, resistance is more important and should be drawn first. In uptrending markets, in uptrending trends, support is more important and should be drawn first. Okay? Because in downtrending markets, what do we want to do? We want to sell short. Trend is your friend. Well, where do we sell short? As close to resistance as possible. Where do we place our stops? Above resistance. Where do we take profits? Well, that's near supports. That's not as important, though. Let's first try to get our entry and stop orders correctly, okay? So we need at least 2 significant high prices to draw resistance, which we have. Current, long-term, downtrending dollar CAD resistance, 103.07. Let's round it down to 103, okay? That's the next place I'd like to sell shorts the next time the market tests and fails to break above. Now, can it break above? Sure. But this chart, and this specifically, this resistance level shows us, and the angle of this line shows us the relationship between the sellers and the buyers over a given period of time. And the sellers obviously clearly are stronger than the buyers at a certain ratio. Well, I'll make one number up, 2.8 to 1. That means for every 2.8 sellers, we have 1 buyer. I honestly don't know what the ratio is, but we can see that the line expresses exactly the ratio of buyers to sellers, or in this case, sellers to buyers. So the resistance line, I like to assume, will continue to hold, and that ratio will not change, that the buyers will not all of a sudden overcome the sellers. Now, if there's a fundamental piece of news, non-farm payrolls, a central bank meeting, anything can change trend. But I like to place my trades with the anticipation that I'm not going to guess the moment in time where things change. I'm going to try to place a trade with anticipation that things won't change, especially in the foreign exchange market. If you think about it, how much is there? $3.2 trillion that goes through the FX market every day. For this chart to change its trend, that has to be a significant, tremendous, enormous piece of capital that comes into the market that changes the trend. Okay, now, support. It's not as significant as resistance, but it does connect significant lows, and guess what? Within this downtrending market, we have a range. You will see this a lot. This is a little triangle. In this case, this is a symmetrical triangle. Shows a relatively even rate of buyers and sellers on the support and resistance levels. Now, you will see the market oftentimes within a long-term trend establish little ranges. Statistically, I believe that the market tends to break out of these range-bound clusters in the same direction as the overall trend. I think it's just a logical assumption. I've never actually gone back on a chart and counted how many triangles and which direction they broke. But my best guess, and where I'd like to place my trade, is with the anticipation that these little clusters, these little range-bound markets, will break out over the long run, have the tendency to break out in the same direction as the overall market, in this case to the downside. Now, I threw on the RSI indicator. We cover these indicators in some of our other discussions. I'll refresh the chart right now. This is another way to confirm. You may wonder, hey, am I in a range-bound or trending markets? Well, the RSI indicator, I won't bore you with the details. I'm sure you folks are familiar with it, but essentially we have levels of 30 and 70. Under 30 represents extreme oversold markets. Above 70 shows us extreme overbought markets. What happens when the market is between 30 and 70? Especially when we're close to the 50 level. This is a telltale sign that we're in a range-bound pattern when the RSI is not below 30 and not above 70, when it's between 30 and 70. Maybe you'll ask, how would you define a trend and the strength of the trend? It is an excellent question. How do you define a trend? Well, job number one in defining a trend is I want to see the market achieve new highs or new lows over a given period of time. I'll give you another chart, and this will very much paint a picture. Now, this is a euro-dollar daily chart, okay? Over the long term, clearly we're in a trending market because we can see from the left side of this chart from January till about, what is the all-time high euro-dollar, 149.66, established when? Late November of last year. Wow, remember those days? Well, from the beginning of our chart, from January of 07 until, really the highs established November of 07, so about 11 months in January, in 2007, I should say, the market was in a trend because we can see over a certain period of time. Why do I say certain? It's subjective. On a daily chart, we're looking back 11 months. On a 1-hour chart, we may look back 30 days. But on that picture of the charts that we see in front of us, has the market consistently made new highs or new lows? In this case, the answer is yes. Now, I'll draw you a line and say, okay, let's take this all-time high, the euro-dollar. Wow. Has the market made? Well, you know what? I'm gonna adjust this line, okay? For a very, very important reason. I'm gonna draw another line, and this is gonna mark our levels over here. Okay. Let me zoom in one frame, and I'll refresh the charts to make sure you folks have a clear picture. Okay. It's an excellent, excellent question. We can see, you see the vertical line I drew? The white line? That's roughly around October 19th, where my mouse is now. From that point moving forward, from October 19th till now, has the market made a new high or new low? Well, it made a new high at 149.66. Let's drag this over there. But from that point moving forward, have we made a new high? We have not. So in my opinion, the uptrending market failed or stopped around the end of November. 149.66, November 23rd. That's when the trending market stopped because we failed to make new highs. Now, if we pulled back and then made new highs, we would have known, hey, the market, in fact, is making a new high. Another way to tell is that if and when we break, and let me erase all these lines and give you a different idea, a different way to measure. Are we in a trend or are we in a range? We have the support line. Let me refresh the charts. Alrighty. When was the support line broken? Support line was broken, well, really, it was broken December 13th. That in my book is another way to tell. Did the market make a new high, or did it cross back below our uptrending supports? Once we cross back below the support level, is it a downtrending market? No, because we know intuitively that trending markets turn into range-bound markets, and range-bound markets turn into trending markets. How do I define a trend? Well, that's how to define a trend. The strength of the trend, excellent question. I would very simply look at the angle of our support line in an uptrending market, or the angle of our resistance line in a downtrending market. We could say, well, you know, if we really wanted to stretch the lines as much as we could say typically, or technically I should say, maybe the euro dollar is still in an uptrend over the recent term, but notice how our new support line is now less aggressive, has a less steep of an angle. Well, now the strength of the trend, if it is a new, and I don't think it is always the case where it is 100% trend or 100% range. Usually, it's a little bit of a mixture of both, or a little bit of trend, a little bit of range. On the left-hand side of the chart, I would say we had 80% trend, 30% or 20% range, 30%, right? 20% range. But as the chart moved forward to the right-hand side, maybe the trend moved down. The percentage of this market is now 20% trend and 80% range. So it's a ratio. How much of the market wants to make new highs and new lows? How much of the market wants to contain itself in a range? I'd say we're a pretty strong case that we're in a range-bound market. However, where is the euro dollar likely to go? I could throw a poll on, and I could ask you folks, but I think I probably guess the answer. If you were to ask me, I'm going to erase all these lines and give you one more long-term picture of the euro dollar. And the euro dollar, in my opinion, on a long-term basis, is still very much in a trend to the upside. Is it possible that we go above 150? It's possible, and it's probably pretty likely. Now, I say that as the euro dollar goes down to 117. Now, of course, fundamentally, that's a whole different discussion. European Central Bank has rumored, or has now not rumored, has said during the last meeting about a week ago, that they are now open to rate cuts. Well, the number one driver of the foreign exchange market is the anticipation of higher, lower rates. Therefore, fundamentally, the euro dollar has a good chance to go down. That's one of our trades over here. But with that said, the chart does not lie. And notice, by the way, one more time, I'm going to zoom in. Former resistance, our old ceiling that was broken, guess what? It became our new floor. So the market is not only in an uptrend, it is now uptrending at a higher angle. Now currently, over the past month or so, 2 months, we're in a range-bound market. But however, we know the range-bound markets pretty much have the tendency to break out in the same direction as the overall trend. In this case, to the upside. Now that we know we're extremely bullish on the euro, at least until we break support lines, let's take a look at a different story. Pound dollar daily chart 197.02. Within this pound dollar downtrending trend, we have range-bound markets that do occur on a shorter term basis. How do we know this? I'm going to throw in my RSI, and I'll show you what we're looking at. Notice when the markets, or the RSI, did cross below the 70 level, or I'm sorry, below the 30 level, or in this case above the 70 level, didn't happen here. This is a trending market condition because the market not only was able to achieve lower lows, but also was able to cross below the 30 level, which shows an extreme weak position. Frank is also around the middle of the daily Bollinger Band as well. Yeah, you're absolutely correct. I can throw the Bollinger Bands on here. And that, by the way, Frank, you should be on the payroll because that was the next thing I was going to mention. Where are my Bollinger Bands? There we go. Okay. Okay. Bollinger Bands are another excellent way to determine, are we in a range-bound or trending markets. Notice, in a range-bound market, which is what we have for the moment right now, the market has a tendency to cross above and below this 20 simple moving average, which is the center line, and the Bollinger Bands represents the upper and lower lines at the bottom and top of the chart. Now, in the trending market condition, where the mouse is here, this is trending because notice the market is only on one side of the simple moving average, in this case, hugging the bottom Bollinger Band. However, in a range-bound market, how do we know the trend is over, at least for the time being? Now we cross above the simple moving average, back below, back above. Now we can use a buy low, sell high type of approach. Okay, let's show you another chart, a little bit of a better example. That's not a good example. I'll give you a good example. Ooh, I love this chart. Okay, let me refresh. Kiwi dollar, New Zealand dollar against the US dollar. Arguably, we are in a trend to the upside. Long-term support lines are drawn by connecting two significant lows. The first one was all the way back in 2006, in June. The next significant low, well, that's in August of 2007. So about 14 months for this market to establish its new uptrending support line. However, in that period of time, we have smaller trends and ranges that do emerge. And I'll zoom in and show you how you can play these trends. Now, the Kiwi dollar, about a month ago, I would say, there we go. About a month ago, broke down below what we thought was our support level. In this case, this is what we refer to as not only an order being stopped out, but a bear trap. A bear trap is when the market breaks down below our supports. It looks like a breakdown. It looks like the market is reversing back to the downside, but then it doesn't, and it rallies back up. Therefore, if I go long based on this uptrending support line, when the mouse is here, I want to go long, place my stops below here. So if we do go below this level, the support level is orange, or I should say purple line, then we'll get out of the trade without losing too much capital. Okay, if I think this is a breakdown, I want to place my stops on the other side of the supports. And again, if we broke down this below the support and this was a real breakdown, the support should become our new resistance. Therefore, the moment that we cross back up, well, we lost money in the short trade as the market then reversed back to the upside. Now what has happened lately, the market has established very much a range because we have now had a lot of problems getting above the 80 figure. If we get above 8.8 spot 0000 or spot 80000, the 80 figure, then I think the Kiwi dollar establishes a new trend to the upside. But now we've a little bit started to run out of gas on the Kiwi dollar. And this shows a very gradual change from a trending market to a range-bound condition. Can we throw the Bollinger Bands on here? Of course. And we can see within, this is actually, according to the Bollinger Bands, very interesting. And let me refresh my chart for you folks. According to the Bollinger Bands, we are actually in a range-bound market. Notice how the market crosses above and below, above and below, above and below the range-bound market. Now, like I said before, it's never a pure range, never a pure trend. If it was a pure trend, the market would go straight up or straight down. That rarely occurs. In a pure range, the market would be flatline. What we have here is a market that's a range-bound market, but with a general trend to it, not to confuse you too much. But I say it's range-bound because the market crossed above and below the Bollinger, the simple moving average, the 20 simple moving average in the center of the two Bollinger Bands. However, notice, so that tells us range-bound all day long. However, notice the market has a general tendency to go to the upside. So in this case, well, we said range-bound market, buy low, sell high, right? Well, I would then want to adjust that to the fact that the Kiwi dollar, generally speaking, has a tendency to trend to the upside. So one example of how we could adjust this, we could go long 2 lots or 2 mini lots, whatever your position size determines or calls for. Go long 2 mini lots, but if we sell short, only sell short 1. Because in my opinion, we have a greater likelihood for the market to go up, a greater likelihood for our short orders, our orders to sell short the market, not to make money, because eventually the market's going to break out. In this case, it did not yet. But because the market has a general tendency to go to the upside, yeah, we could use a buy low, sell high approach, but I'd want to do so with more of a bias on buying, on going long. Where should we enter long? It's a great question. Well, in a range-bound market using the Bollinger Bands. I'll answer the question 2 different ways, Mabel. In a range-bound market using the Bollinger Bands, I want to go long. I want to buy the market. The next time it crosses below and then back above the lower Bollinger Bands. The last time that occurred was, January 22nd. Imagine buying this thing. Well, it was right around 7,500. 7,500, we're at 78.99, and you would have been able to hold the trade all day long. And guess what? You also get a very nice carry trade to boot, especially because the dollar interest rates are so much lower. So, and that's another, it brings me to the next point, which is we should always try to focus our trades in the same direction as the carry trade, because you say to yourself, well, I bought the Kiwi dollar, and yeah, I made some money initially, but now it's kind of range bound. But we're collecting interest every single day that goes by. So in my book, I say let it stay in a range-bound market. As long as we don't go down, and as long as we continue to go sideways, I'm collecting interest every day. It's like I just gave a little loan to somebody, and they're paying me interest every day. Even though the Kiwi dollar is not moving up, we're still getting interest every day. Okay, so according to the Bollinger Bands, we're going to go long as soon as the market crosses below and back above the lower Bollinger Band. That's step number 1. However, our purple uptrending support line that currently lies now at 76.23, it was around 75.78. I want to go long when the market tests and fails to break below the support level. Now, we did break below it, but the fact that we broke back above gave us another chance to go long, again, placing our stops below the uptrending supports. We can see the market 1, 2, 3, 4, 5, 6 times it hit the support level. Only the last time did it actually break below. So we would have lost money possibly 1 out of the past 5 times, conservatively, if we had placed our stops below the support level with a little bit of breathing room. Where would I sell shorts? The next time the market crosses above and back below the upper band. But in this case, again, because there's such a distinct trend with the Kiwi dollar, I would prefer only to go long this pair. Alrighty, let's go to the next one. Oh, so much to cover. Euro-yen, 4-hour chart. Now, I would say also, on a side note, we mentioned the carry trade. That's the difference in interest rates between the 2 currencies in the pair. Sometimes they're pretty close. Sometimes there's a large divergence, difference between the 2. The yen crosses. The euro yen, pound yen, Swiss yen, Aussie yen, Kiwi yen, so on and so forth, tend to have a very, very large carry trade because the Japanese yen has such low interest rates and all these other currencies have such relatively higher interest rates. Capital tends over the long term to move into those currencies with higher rates. Therefore, in terms of a carry trade, although lately it has been very, very lucrative to sell short these carry trades, when normalcy returns back to the markets, in the past, I've liked to favor the carry trades only to the upside. Now, does that mean if the pound yen is showing us a good trade to the downside, we can't take it? Absolutely not. But if you're a little bit more of a longer-term trader and the chart is basically neutral, I'd like to favor the carry trade. Now, euro-yen 4-hour chart, range-bound market galore. Symmetrical triangle. We broke above our downtrending resistance. Our resistance at the time was 157.38. We tested, and I'll show you what I mean. I'll zoom in on the chart 2 times and show you what we have in store for us. Resistance was broken, and notice how the red candles came back down, and the new support level, our former resistance, failed, or the market failed to cross back below. Beautiful. So now we can see our new support now currently lies at 157.35. Let me go back out for a moment. 58.90 is a good resistance for a sell. Let's have a look. Well, in my book, I like to look at the horizontal price levels. Right around, my chart says 158.85. I had disregarded the long wicks. Jack, you're right on. You couldn't have said it better myself. I could be off 5 pips, or maybe each of us is off 2.5 each. No, I'm kidding around. It's 158. I always tend to focus on the large round figures. So in this case, I would say 159.00. Just because the market likes big round figures, and so do options orders and stop orders and all that other good stuff. In addition, what we could do is draw our Fibonacci lines from the tops to the bottoms and say, hey, where does resistance lie? Guess what? Look at this. 61.8% Fibonacci line matches up with the highs just below the 159 figure that myself and Jack 1 has mentioned. Therefore, I like this level as a retracement. Could we still be in a range-bound market? Yeah, we've broken above our first possible resistance, but we have another one to go. So it's a little bit of a subjective science from time to time. You know, it's not as easy as rocket science, as they say. Do we have time for one more chart? We have time for a few more charts. Cable yen, we mentioned this. I wanted to talk about this because this has been just such a wicked pair lately. Cable yen, can you imagine last August, cable yen was at 251. It came down to almost 200. That's almost 5,000 pips in 6 months. I wish I could make 5,000 pips every 6 months, right? It's a big deal, though. It's about 1,000 pips a month. Well, downtrending long-term resistance. And I'll admit, I thought the market, I don't like to hope, I was really anticipating the market was going to test and fail to break below or break above our intermediate resistance line. That currently lies at 211. Well, we did. My stop order took me out. I was not very, very happy of having my stop order. I was happy to have a stop order, obviously, but I was not very happy to see the market go up. But you know what? Well, it's not my job to get emotional. I try not to. We have another long-term downtrending resistance. That's the good news. And that currently lies, by the way, around 215.70. Now, in addition, in trending markets, for those of you, I won't bore you with the details now, but for those of you that are familiar with the Fibonacci lines, they can be used very, very effectively, I have found, more likely in range-bound markets. And I'll zoom in and refresh the charts for you. In trending markets. Reason being is because Fibonacci tends to project new possible highs and lows over a given period of time, whereas in a range-bound market, the market tends to go to support and resistance and cross through our Fibonacci lines. Fibonacci lines show us new possible support and resistance levels when we have higher supports and lower resistance levels. When it appears the market is walking down a flight of stairs or walking up a flight of stairs in a trending market. But in a range-bound markets, well, not necessarily the case. Where is a possible resistance level in cable yen? Very, very good question. Notice our 38.2% Fibonacci level matches up with our downtrending long-term resistance. That currently is around 213.30. So we have a little bit of time because as time moves forward, this downtrending resistance tends to ratchet lower and lower. Okay. We have that. We also have the high spike at 213.98. We'll say 214, the large candlestick spike, the most recent significant high. Also notice this little cluster over here, going back to the first week in January, our former supports could become new resistance. I only have about 30 seconds left, so I wanted to mention one quick thing, and if you forgot, we have a very, very special gift for you. Courtesy of my site, forexlounge.com, we've created a brand new, and forexlounge.com. We've created a brand new trading course. It's absolutely free. It takes you through the beginners of fundamental analysis, technical analysis, chart reading made easy, a number of different indicators, Fibonacci, money management, trading techniques, so on and so forth. Just go to our website. It's on our forum. Look for the forum button. And all you have to do is register. It's absolutely free. There's no commitment, and you'll be able to access our free trading course. It's a number of animated movies with yours truly speaking on them. I don't have exactly the greatest choir voice, but with all that said, we have about 7 different chapters to take you through the beginners of trading the foreign exchange market, and even if you're familiar with it, it's always a nice refresher. At any rate, I want to thank you very, very much for joining us. I thank FX Street immensely. It's always a pleasure to be here. If you have any questions, please feel free to email me, Adam, at forexlounge.com. And more importantly, stick around. I know FX Street has an entire calendar today, and please visit their calendar. I will be speaking later on this month as well. Thank you again very, very much, FX Street, and to you, the listeners, we thank you. I wish you a fantastic day, all profitable trades, and we hope to see you back real soon. Have a fantastic day.